All right, good morning, everybody. Thursday, October 22nd. This is Dan coming to you from tradingology.com. And as always, our friends over at Strong Market, we have Dave joining us on Thursday. Good to see you guys.
Good morning, Dan. Good morning, everybody.
Good morning, Andre. All right, so we got a little quick recent down move, but we'll cover some of the bases here. I'll pull over the spreadsheet, and one thing I did note is we had some new fresh bearish hurting in the first column with the full pipeline and the flow increasing once again. So it took a little dip down to 96, then we're right back up to 108 with MT vol also bounced from 82 to 85. I did notice. So things are moving back in the negative direction from a bearish standpoint. So those kind of put together what I was looking at, and we see this morning is kind of playing that out, where we look at the indexes and they're all down across the board so far. We had a little spike here, but one thing I did notice yesterday, when we start to see all this up and down on the SDs, that's that volatility coming into play, and that typically is followed by a drop in the market. At least that's what I've personally remembered, and I think Dave has always clued me in on that as well. As when that starts bouncing, even if they're a bunch of canceling orders, that's a sign of high volatility coming.
Yep, that's true. One other thing on the spreadsheet that I want to point out is that we had bullish hurting in the last column, and we had bearish hurting in the first column, and that's called a long tail. So it's kind of like a handover. You know, it's like the Bulls are done. They're going to hand over the ball to. It's like football. You know, it's like there was a fumble. Now the Bears got it.
Yep, I like the fumble analogy. That's pretty good. We had it. Now you take it because you're taking control and it's going your direction.
Exactly.
And just to keep up with the calendar events, we did have that jobless claim that we knew were coming out. I think I read in here, actually, I opened it up. It was lower than they expected, than they forecast, so they actually put it as green. I personally think that's still another 787,000 people that are claiming unemployment. So I don't know how that's a good thing, even though it's a lower number.
How many people in the United States?
What's that?
How many people in the United States?
300 million left, I knew.
300 million. So they've only got another, oh man, we've already gone through 12 months almost, not 8 months of million plus.
Yeah, look at this history. Since March. Yeah, they claim this when you expand this out and you read into this. This is the first time since March that it hasn't been 300,000 or more.
Yeah.
So yeah, add these up, put those in a graph, and that's absolutely ridiculous.
Yeah, it's crazy.
But I suppose it's not as bad as 6.6 million or whatever. Yeah, 6 million there at the height.
Yeah.
But that's still a lot every week.
That's way more than the GFC. I mean, in 2008, 2009, I don't think we ever hit 800,000 a week. We were doing maybe 100,000 a week or 120,000, 240 maybe at the most. And so this has been going on for 8 months. Every single week we get another 800,000 unemployed.
Yeah.
It's insane. I think eventually the market's got to wake up to this fact. People aren't going to have any money to spend. Where's the account? Consumers are 80% of the economy. What are they going to spend their money on?
Right. That's how we see the velocity going down. They're not spending on anything. Money's not moving.
Yeah, that's right. Well, Amazon had their biggest Prime Day ever.
Well, good for them.
Not entirely unexpected because everybody's ordering stuff online.
They didn't get anything from me this time.
But how much did that take away from local businesses? A lot.
Right.
Yeah.
Yeah, agreed. So there's our daily rant on the economy and jobless claims and how they perceive things. Perception is their reality.
Absolutely true. We had a nice bid up on Bitcoin hit 13,000 last night. I don't know if you were watching, but
yep.
As soon as it hit 13,000, though, the sellers piled in and drove it right back down to like 12.8. And then I think it's still up pretty good, 12,877 right now.
I didn't look at all this morning yet.
But we got the dollar index higher this morning, so that's going to probably put some sort of damper on cryptos today. And we got the market lower. Now, last night when the futures opened, the Dow was down almost 250 points.
I was noticing that as well. As I called it a night, it was down quite a bit, so I was curious what it was going to open up at. So I was surprised to see it back to almost even keel, but then we're giving it right back now.
Yeah, rolled right over.
So I know yesterday we had a few questions people wanted to ask. Well, how do you find your asymmetric trades, and what do you look at, Dave? How do you come up with the ideas of the SPY's one thing? We know that's more of the total market, right, where we see that's in a bubble, but what's a good way that you look at it that people can look at to identify a potential bubble? And if they do, like I was trying to think of, the housing market would be a good one in my mind, because eventually I see that coming down. So what would be a good instrument maybe for the housing market, or how do you just find asymmetric trades yourself?
I base it on my macroeconomic picture. So if I'm looking at something long term, I'm looking at the macro landscape. And so I'm looking at potential events that are going to happen in the future. And I try to identify these, before anybody else does, so I can get a good price on the trades. But I mean, hey, look, we're going into an unprecedented fall season in the United States, and we have an election coming up, and we're dealing with a lot of serious issues: unemployment, not being able to get back to work, productivity is down, small businesses are being wiped out by the day. We have interest rates that are going to remain low. The Federal Reserve is coming in and they're saying, hey, look, we're going to keep interest rates low until 2023. So one of the most recent asymmetric trade I was looking at was on TLT. TLT is the long-term, it's an ETF. The average maturity on the TLT, they invest in bonds, and the average maturity is about 20 years. And so I know that the Federal Reserve said they want to keep interest rates low. They're going to be buying up the long end of the curve, so they're going to keep interest rates bonds rising, and the nominal rates of the 30-year bond are going to be kept under cap. Right now, it's about 1.6%. That's the highest it's been pretty much the entire year. So I'm anticipating that the 30-year bond is going to decline in rates and nominal rates. And when that happens, TLT is going to rise, because TLT will go in the same direction as the bond prices. And remember, bond prices and yields are inverse. So as interest rates in the 30-year come down, the bonds rise in price. And so TLT, with an average maturity of 20 years, is going to rise in price. So I said, okay, well, what happened in fact, if you have a chart of TLT, we can take a look and see what happened during the March period, where it just kind of went crazy, and it went up from, it was going up already, but then we had these wild swings back and forth. And I said, okay, where's the probability of it going? Well, one of the trades that I looked at, and when I look at an asymmetric trade, I want to look at something. I try to get a widest spread I can for the least amount of money I can. So I'm looking for longer dated options with a very wide spread, out of the money, so that if the event I'm thinking about is going to occur, I'm going to be able to profit from that immediately. Because if you buy a spread for 15 cents and the strikes are 40 points apart, we got a potential of a 40-point wide potential return. That's the max on a 15-cent spread. That's an asymmetric trade, in my opinion. So yeah, you got to go out to do a weekly, because it shows a little bit better, I think, or even a daily. It's fine. But you can see it's been in an uptrend, right? Since 2003. It's not going to stop. We're going to get a continued uptrend in bond prices until the 30-year hits like zero. And then at that point, they're going to say, okay, then we're done. That's enough. And we're going to let interest rates rise. But you see the wide swings there from 140 up to 180 just about in March. And so what happened was when we had the decline in March in stock market, bond prices, everybody was flocking into bonds because that's the safe haven. And so all I can say, my entire thesis here is that we're probably going to see more volatility. In fact, I heard Paul Tudor Jones this morning, one of the greatest traders of all time, on CNBC. He had a terrific interview, except that it drives me crazy when they interrupt him with questions when he's getting to something really good. Something really, really good. Paul Tudor Jones is probably the only guy I really listen to about markets because he's a macro guy. And I just love exactly what he says. I just think he's absolutely spot on. He caught the 1987 crash and made his name in that because he saw what was coming, and he just made millions and millions on that. Very sharp guy. So anyway, he's also of the opinion we're going to get a lot of volatility. Now, here's something that he did say that was really interesting. Part of my macro thesis is that we're going to get a lot of volatility before the end of the year. If we get a lot of volatility, we're going to see the VIX shoot up higher, and we're going to see a flight to quality, which is going to be the 30-year bonds and treasury, actually the entire yield. People are going to flock into them, right, raising the prices of all the bonds. TLT is going to be a beneficiary of that because that's what the Fed is buying. So if we do, it's going to shoot up to 190, 200. It doesn't even have to go up that high for my macro thesis, the asymmetrical trade to work. All it has to do is shoot up sharply. And so the strikes that I've got, and the expiration is for January 2021. And let me pull up the strike prices here for you.
Yeah, I can see. TLT. Whoops, not RLT. That doesn't work.
No, TLT.
Sometimes the fingers don't work.
So on TLT, I've got the January 21, the 200 and the 225 call. So I got a 25-point spread, which I believe I got.
Would you say January 22?
21. So it's only till next January. And I got I got it for like, I don't know what it is. What is it now? 17 cents I paid for the 21 200 call, and I paid 9 cents for the 225.
So 200 and 225, is that what you're saying?
Yep, 200 and 225. I paid 17 cents for the 200, and I paid 9 cents for the 225. So I got that spread for 6 cents.
And so Andre's asking, can you explain the relationship between this spread and the return? So when you say the spread determines your potential profit, how does that work out, and what's the easiest way for him to think of that?
Not sure. Well, I mean,
like you're saying, the wider the spread, the more potential, just in a credit or a debit spread, right? In general.
Yeah, at expiration, yes, at expiration. So if you've got a 25-point spread, that spread, if you bought the lower price strike, you sold the higher price strike, the maximum profit potential on that spread is this difference in the strike prices. So the 200 to 225 that spread can only be 25 points maximum. That's a maximum profit on that spread, is the difference between the strike prices, no matter what you paid for it. I paid 6 cents. It can go to $25. I don't know what the return is on that, but it's got to be, like 100 plus. It's got like a 200, 300% return, right? So, yeah, so it put up, now I did, on this particular trade, I ended up doing 100 on contracts on each. So if you put 100 contracts in there, you can kind of tell, and it's right now it's at 4 cents.
And that's the one side, that's the mid, so you're probably not going to get the mid. But you can try.
Yeah, you can try. I certainly tried. I think I ended up dropping it down to 5. And then I went up to 6. I got it for 6. But you can definitely try to get it for 4 or 3 even. So that's going to cost you $400. Now that's your maximum loss on a debit spread is what you pay for. You can't lose any more money than that. But the potential profit, now take that and put it into the analyze trap.
Oh,
okay?
yeah.
So if you, I think if you click way over to the right, you can hit analyze, or maybe you can.
I haven't done it in here in so long because I don't trade in here.
I typically only trade stocks in my TOS, but every once in a while I get lazy and I don't want to switch accounts. So sometimes I'll do them. But you can see it, yeah, scrunch it up there because we're at approximately 159 right now.
Oh,
You gotta, go the other way. There you go. Okay, now you got it. Now, if you go all the way to the left and you go to 180, you can see that, or where we are right now, the maximum you can lose is $400. The purple line is what would happen if it spiked up today to 183, you'd make about $3,000. Or no, more than that. What does it say?
180 be about 10,000.
Yeah. I mean, you're going from $400 to $10,000. It doesn't really have to spike that much, but there has to be some sort of an event, some sort of macro event where you get a spike in the TLT because the stock's declining or some other event that has the potential for happening. And as you continue to go higher, I think it's going to hit 200 or more. If it does, then you're up around $40,000, $50,000 in potential profit. Now, if it goes all the way up to the top stop strike price, which is 225 at expiration, you got what's that?
133.
133, but it's actually more now. Yeah, you got to look at the blue line because that's the expiration. Is
the blue line's 249.6.
Right. So if it goes up past the 225 strike price at expiration, you got 225,000. That's asymmetric. That means you got a very, very low entry point. You got a macro event potential. Now, I'm not saying that this is not a trade that you would do like every day, every week. We're in an unusual time right now between now and the end of the year. One of the things that Paul Tudor Jones did say was that he thinks Biden's going to win. If Biden wins, he's going to increase tax rates.
Mm-hmm.
And not only that, but he's going to make it retroactive to the beginning of this year. So capital gains rates could go from, what are they, like 28% or something like that now to 43%. I'm not sure what the capital gains are. Well, I mean, the long-term capital gain rate, I think, was 15, and he's going to raise it to 28 or something like that. So the difference is about 13 basis points. If that happens, people are going to be selling stocks at the end of the year. He's anticipating that the Democrats are going to make it retroactive to the beginning of this year, not for next year, the beginning of this year. If that's the case, people are going to be selling stocks like crazy before the end of the year. So if that's the case, then we're going to see a macro event in which stock prices probably decline very, very sharply. And we get an event that goes into the VXX, the VIX rising past 100 probably. We're going to get TLT flight to quality into the bonds. Bond prices are going to rise. TLT is going up. The dollar's going up. People are going to get out of risk assets and they're going into the dollar. That's why all of my macro, right now at least, every one of my asymmetric trades has to do with that. Now, if I'm wrong, I'm going to lose a few $1,000, but you put $400 into this thing, that's the most you can lose. So that's why I'm short. I've got SPY puts, they're way far out of the money for expiration of next March. I've got TLT, which you just saw. I've got UUP, which I put in the long term on expiring January 2022. And I've got VXX calls. All asymmetric trades, low cost. $1,000-1,500 at the most, but big payoffs.
And I think the key here too is for people to stay on that update service, or just one good reason to is even if they don't play out, you were mentioning early on too, that you don't just hold it and just eat it. You're able to actually adjust that later and turn it into a different spread.
Absolutely. So if you go back to the trade tab there, I mean, this one is only $400. So
yeah, let's
not
say
even
I don't
sure.
want to lose a 400, Dave. What do? I don't want to take my max loss.
I don't even know if it'd be worth it to save that one. But let's say, okay, so you're long the 200.
Yep.
Right? You're long the 200. Let's say, okay, nothing works out. The stock market goes up. Bond interest rates start to rise, which is, I think, absurd in my opinion. But anyway, so you're holding the long 200 calls. You sold the 225s. Well, those 225s go down to like nothing. So you made money on those, right? You sold those, you made money on those. All you have to do then is convert it to a credit spread. So you're still long the 200s. You paid 4 cents for the spread.
Mm-hmm.
All you need is 4 cents back. And you'd actually make money because you already made money on the 225 shorts calls. So if you look at the 195s, what's the difference between the 195s and the 200s? If you sold those right now, you get 23 cents for it. That's 2 cents. You get 2 cents back.
Yep.
And well, I only paid 17 cents for those 200. So I would make a penny if I sold it at 23 cents right now. But let's say you even try to split the difference, you got it for like 25 cents. Well, I paid 4 cents. I paid 17 for the 200s. Now I'm up 8 cents. So I actually make 4 cents on it. So I'll make my $400 back.
There you go.
So you convert it to a credit spread if the macro event doesn't happen, and you try to get the closest strike below your long strike to sell it.
All right.
That is the skinny on the asymmetric trade.
So study that one, rewatch this one, guys. It will pay off in dividends, because there's nothing more you can ask for than that in my book. Is yeah, like Dave says, this isn't something you do every day. But
Yeah.
can you imagine risking 400 to make $250,000? Not that we're gonna actually hold it and it's gonna go to 250, but the potential is actually there.
Yeah, and it doesn't even have to do that. All it has to do is shoot up one day to like 180, 190, and you're making $25,000, $30,000.
Yeah, just take the little bit, like we talked about before. Grab the cheese before it goes later, because chances are if it does spike, yeah, we might get a reversion back where it comes back down. So grab it while you have it, and you decide what is your profit goal. This just gives you the opportunity is there, right, if things happen.
And so you might ask, well, these are big macro events that have the potential for playing out, but what do you do when there is no big macro event pending? You know, we're in a pretty big macro event situation right now. But what do you do if you're if you're in 2017 and everything's going up? Well, you buy long dated, out of the money, long calls on Apple or Amazon or anything else, and try to get it as cheaply as you can. And and you make those plays. I mean, yeah, you can do it on individual stocks just as well as you can do it on the ETFs and indexes. Anything you think is going to move big in a long term, it works.
Yeah, the key there is it's low risk. You're 100, 1,000, whatever your risk factor is there. You don't have to do 100 contracts. You could do 50, whatever. Or if you have a larger scale, you could do 200 contracts. You decide what is your risk appetite. He does put these in the RTUS. So the one around, what was the last one? The UUP, was it?
Yeah, I think it was UUP.
Yeah, UUP is in the R test. So go in there and you'll see the screenshot, Andre.
I'll put TLT up there. I just got into that one, so I'll put that up there.
Perfect. All right, and we're close to the top of the hour once again. Well, that was a fun little bounce while we were away.
It's just volatility. I mean, it's just, it's just an increase in volatility. And as long as we get it in volatility, I think we're going to continue to go lower, but we'll see.
It feels like a repeat of yesterday. We got Spaghetti Junction happening here. We're the middle of the road again. Look at this low volume numbers again.
Mm-hmm.
Internals kind of bounced off that zero where we've seen that historically as well.
Right. Maybe there was some announcement. That's why it bounced. Let's see what we got here.
I tried to look at that yesterday when there was that midday event and I didn't see anything. Suddenly everything shot up like 100 points on the Dow. It's like, what's going on here? There was nothing.
Yeah, nothing on CNBC. Nothing at all.
Yep. So keep your eyes on the RTUS for the TLT info and when things play out. I'm sure Dave will be happy to update when if he does have to change to a credit spread or whatever potentially happens. He'll keep you guys posted there.
Yeah. So we're looking at volatility to the end of the year, and after that, we'll say, okay, well, after the election, I mean, so
right.
We'll see what happens after the election.
All right. Kevin says he closed out a VXX trade from 11.6 paper trade for 175 profit. Good job, Kevin.
Nice.
Now you see how it worked out. The more time behind the seat, the better. Get that seat time. That
is a consistently profitable trade that you just can't beat the VXX system. I mean, it's almost a no-brainer. The only reason we're not doing it now is because of the potential for high volatility. But otherwise, maybe once every 4 years you don't do one.
It's kind of nice to take a break every once in a while too, though.
Yeah. It gives your brain a break.
Exactly.
All right, guys. Well, have a fantastic weekend, and we will see you. Or no,
we'll be back next week.
Okay, we'll be back Monday, guys.
Absolutely. So appreciate all the info on the trades for Asymmetric, Dave. Thank you very much.
Sure.
You're welcome, Kevin. Good to see you. And we'll catch you guys on Monday. So you guys have a great weekend.
You too. Take care, Dan.